Okay, welcome to the September 20th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about Argentine export basis and its impact on soybean oil prices, and then the EMTS data that came out last week, and then go through our normal review of margin and credit price projections. Before we get started, though, there's one thing that I want to clear up from last week. The last question that I got last week was about the new IRA credits, and I think it was something along the lines of, does the credit have an adjustment in it for different types of fuels? I think I kind of said, yeah, that it kind of does. And that was a poor answer. The truth is that there are sort of separate credits for the individual fuels, or there are separate rules for the individual fuels. And so each rule has its own set of rules, I suppose, or each credit has its own set of rules. And the sort of common theme among all of them is the LCFS like focus on carbon intensity. And so the lower the CI score, the higher value of any individual credit. The main point there was really just the distinction between sort of having one credit or one rule that governs all the credits and having separate rules for the different fuels. So I just wanted to clear that up before we get started. Okay. This past week, we saw Gulf basis drop by 4 cents. Gulf basis had been relatively strong over the last couple months anyway, and had risen up to about 9 cents. And then in the past week, it dropped back down to 5 cents. And a big reason for that has been, I guess, the success of the soy dollar program instituted in Argentina. Now, the program, which was announced in early September, has been very successful in trying to get Argentine farmers to sell soybeans to exporters and more importantly, Argentine crushers, so they can turn the beans into meal and oil and then export it, because the Argentine government relies on those export for foreign currency reserves. And because the Argentine peso has been so weak, and because the inflation rate in Argentina is so high, farmers hadn't been selling soybeans. And so as a result of that, crushers couldn't produce, and soybean oil exports weren't really available to the market, and Gulf basis rose, Argentine basis rose too. But after the program started, farmers sold a lot of soybeans. I think there were more than 5 million tons in new sales as of a little while ago, several days ago, or maybe even as long as a week ago. And the percent of last year's harvest that has been sold this year, the percent of the last harvest that's been sold this year was getting close to the prior year. And so by all accounts, it's been successful in what it was meant to do. Now, the thing is that the impact of that on Argentine basis was pretty dramatic. And so this is a chart that compares basis at the US Gulf with Argentine basis. You can see that Argentine basis had been declining since, excuse me, since before the program was instituted, but it's really fallen sharply. It had kind of started to rally back up, and it's really fallen sharply since the 1st of September, which was the program was announced the first week of September. And that has pulled down Gulf basis. So I think the question is, for Gulf basis and to a little bit lesser extent, the availability of supply in the domestic market, is does the program set to expire at the end of September? Does the government extend the program beyond the end of September? Or do farmers sell enough soybeans from now until the end of September, or from the program's inception until the end of September, for Argentine crushers to have sufficient supplies to meet demand until the next harvest, which will be late next spring, after the upcoming growing season. And I think that in general, you see that in almost every country, basically, farmers harvest, and at harvest they sell a lot of their soybeans, or maybe they've hedged some before harvest, but the bulk of sales kind of occur around harvest. Now, Argentina is a little bit different because, again, farmers use soybeans as a hedge against inflation. And so I haven't looked in great detail at what the shape of the curve looks like for farmer sales, but it may be a little bit flatter than it is for the US or other countries where farmers don't use soybeans as a hedge against inflation. And if it is, then that means that maybe it's more likely that the government extends the program, but it's kind of tough to tell, because I think I could also argue that as a farmer, I may want to take advantage of the program and get a lot of my sales done now before the program ends, so that I'm not selling them later, even if prices have crept up, but haven't crept up enough to offset the gains that I would get under the program. Either way, I think the impact in the short term probably tells us a little bit about what's going on in the world soybean oil or in the world vegetable oil markets, and has some implications for the price of soybean oil, and specifically, and then more generally for the rest of the feedstocks over the next 4 to 6 months. I think that if farmers continue to sell and do provide crushers with sufficient supplies to get to the end, to get through the next harvest, then Argentine basis probably remains under pressure, and U.S. Gulf basis remains under pressure. And in that case, then probably more supplies end up being available domestically, and that would also weigh on domestic basis. And that has been a little bit of what we've seen, at least over the last couple of weeks. Particularly, there's kind of two things going on in U.S. basis right now. One, you have this pressure from Argentina, and that impact just broadly on basis. And then the second is that you've got renewable diesel, the growth in renewable diesel production capacity coming with a growth in pretreatment capacity. So instead of renewable diesel producers buying RBD soybean oil, they're going to end up buying crude soybean oil. And so there's a shift in the composition of RBD basis, which is basically crude basis plus refining margin. And what you've seen is refining margin fall to 10 cents last week. And the 10-cent level has been one that has been a pretty crucial level for support since basis took off in April of 2021. It's come down to that level once or twice, and then it's always kind of bounced back. This time, I think because of this, because of the growth in pretreatment, or I guess more accurately, because the renewable diesel industry, or expectations for the growth in renewable diesel capacity, have shifted. A year ago, if you'd asked me, I don't know that I would have thought that as many renewable diesel producers would have pretreatment as I do today. And so because of that, I think that that you're going to have this shift in the composition where before, if renewable diesel producers are going to buy RBD, then the refining margin needs to is probably going to stay high relative to its long-term average. Now you're going to have that demand shifted to crude. So RBD basis may theoretically stay the same. Let's just say that it does. But the component that is the refining margin will shrink, and the component that is crude degummed basis will expand. I tend to think that RBD basis just generally is going to fall in the coming months, because I think U.S. soybean oil stocks remain ample at the very least, above 2 billion pounds, and there isn't really the growth in renewable diesel demand may increase demand, but you also have a growth in crushing and refining capacity. And so I don't know that the growth in renewable diesel production is going to be robust enough that it offsets not only the ample stocks that we already have, but the increase in crushing capacity and refining capacity, and then just the seasonal pattern of crush, where we tend to crush a lot more soybeans in November than we do in February, and so stocks tend to build in the last quarter of the calendar year. Beyond all of that, I guess, just to kind of tie this into what we're going to talk about in a little bit, is the EMTS data that came out last week also showed that renewable diesel production remained relatively low compared to the peak of 136 million gallons in May. It came in at like 109 million gallons, which was basically unchanged from last month. So even if we're having this expansion in renewable diesel capacity and by extension feedstock demand, the capacity utilization rate, or just the flat out the production of renewable diesel, is going to be as important to the RBD basis as the growth in capacity. If the capacity is there, but it's only being used at 60% or 80% or whatever it is, then it doesn't really have to have an impact on basis. But if the capacity is there and it's used at 95% or 100% or whatever it is, then obviously that's a different situation. But that's not what we're seeing, I think, right now. That could change, and we expect it to change by the end of the year, just due to the seasonality in biomass-based diesel production. But at least for the moment, and we expect probably for the next month or two, renewable diesel production could stay close to the current level, and in that case, RBD basis probably needs to come down. And I think as RBD basis comes down, it's going to be difficult to get it back up again until stocks fall to a level that justifies RBD basis at historically high levels, at the historically high levels it's been over the past year or so, or a little bit more. All right, with that, let's go into our forecast. I didn't change my soybean oil forecast this week at all. It remains sort of downward sloping, and soybean oil prices have kind of traded back and forth within this range and have stabilized a bit. I think that a lot of, like I said, I think last week, a lot of what the forward curve looks like in the coming weeks will depend on what the ultimate yield of the soybean crop is this year. like I said, we expect crushing capacity to go up to about 2.3 billion bushels over the next couple of months, and so that should imply an increase in crush from the 21-22 total, which based on the NOPA data looks like it's going to be 2.205 billion bushels, which is in line with USDA September projection. But if the soybeans aren't there to crush, then that's kind of a different story. And so if the average yield for soybeans falls a bit, then maybe crush isn't 2.35 or 2.25 or 2.75 billion bushels, 2.275, sorry, billion bushels. Maybe it's 2.2 billion bushels again in 22-23. And in that case, then I think that you probably at some point would see soybean oil stocks drop to a level that then could potentially support basis at levels that we have seen in recent months, and depending on potentially how small the crop is, could even be higher than we've seen in recent months. Conversely, if USDA comes out next month and says, oh well, we were a little bit too low, and starts to raise the average yield, which is something that has happened in the past, that's not impossible, then I think it's more the forward curve probably looks a lot like this, and basis levels probably kind of follow the same sort of the same pattern, and kind of move lower, especially if La Nina fades and we get a successful start to the South American growing season. Now, Brazil farmers are already starting to plant corn and soybeans, excuse me, but the La Nina hasn't faded yet, and while there have been good showers in the areas where farmers are planting in Brazil, Argentina remains dry, and La Nina is kind of expected to linger into the fall, and maybe even a little bit into the winter. And if that's the case, then you might see a reduction in expected Argentine corn and soybean acres. Based on the national or NOAA's La Nina forecast, it looks like the South American growing season will see a return to normal. There hasn't been a La Nina in history, I think, or maybe there's been like one or maybe two, but I don't think there has been a La Nina in history that would match the length of time that this La Nina lasts, if it lasts through the South American growing season. And so I think that there's probably a better than average chance that that what I tend to think about South American weather is that it's very tough to make money betting against South American weather. Probably returns to be true this year, although there is still just a small chance that maybe that is not it. The only other thing I really want to talk about in veg oils is palm oil. So cargo surveyor data for the first 20 days of September showed a big jump in Malaysian palm oil exports. The two of the three services have reported, and one said exports increased by 30% relative to August, and the other said that exports increased by 40% relative to August. Either way, exports increased by a significant amount relative to August, and as a result, we raised our export forecast for September and sort of by extension for 21-22 by 250,000 tons, if I'm remembering correctly. The interesting thing about the increase in Malaysian palm oil exports was that even though it's a big substantial increase, and we've been waiting for the large importing countries, China and India, to restock palm oil, it doesn't necessarily appear that the increase is being driven by restocking in those countries. Now, they did increase their imports, their purchases from Malaysia substantially through the first 20 days. I think China was up 60,000 tons and India was up 20,000 tons or 25,000 tons, but that 85,000 tons only represented about a third of the overall increase, which would suggest maybe that that Western Hemisphere countries are starting to substitute palm oil for soybean oil, finally. The spread between palm oil and soybean oil futures has continued to move higher, although with the fall off of the September contract, maybe it starts to stabilize or just kind of move lower as the old contract expires. The new contract isn't quite as high as the old contract, and so you get a decrease in the spread that way. We expect the spread to kind of narrow from right now. The nearby contract is at like 28.5 cents, and we expect the spread to narrow to about 20 cents over the next year. If the spread does narrow, I think that the substitution by Western Hemisphere countries probably starts to slow down a little bit, especially if they can get Argentine soybean oil for roughly the same price, or maybe at a bit of a premium to palm oil. But the one, I think, caveat to that is that one of the places that palm oil imports are increasing is the US, and that's because the feed industry is starting to substitute palm oil for soybean oil in the US. And so while some of the smaller countries may switch back to palm oil, or may switch back to soybean oil, because of the anticipated growth in biomass-based diesel feedstock demand and the relatively tight margins in the feed industry over the very long term, I don't know that, and the difficulty just in switching diets for cows, it's not impossible, but it's also not quite as easy as just kind of feeding them soybean oil one day and feeding them palm oil the next day. Mean that maybe the increases in shipments to the US will kind of continue. Now, if the spread narrows, it probably also means that you could see an uptick in demand from India and China, and maybe we finally will get the restocking that I've been waiting for what feels like forever. And if that happens, then I probably ultimately would raise my 22-23 export forecast by a bit. From, we're expecting it to grow by about 1 million tons anyway. But if we see significant restocking in China and India early in the year, then we probably would kick that up just a little bit. All right, with that, let's go to biodiesel. Okay, so as I mentioned, and as you can see in the chart, renewable diesel production, domestic renewable diesel production was basically flat month over month, and still again below the peak of 136 million gallons that we saw in May. Now, I cut my forecast for renewable diesel production for 2022 by 150 million gallons, because the total for this month was like 30 million gallons below our expectation, and it has that gap has been kind of growing. Early in the year we were a little low, and then we started to be too high with our forecast, and that's kind of been growing. And so I took 150 million gallons out. You can see what that means in the chart. It means that basically I expect production to be kind of steady over the next couple of months, and then kind of rise seasonally into the end of the year. The November total, I think, could kind of go either way. It could be a bit closer to this month's total, or it could be a little bit higher. It will just depend on how much biomass-based diesel needs to be produced because of the ethanol gap and the undifferentiated advanced biofuel mandate, and how much we've produced in September and October, and margins. And so if margins do what we kind of think that they're going to do, I don't know that there is going to be a lot of I guess I'll put it this way: the incentives for renewable diesel production probably will be where they are today, or maybe even a little bit worse. And given the fact that that margins are where they are today, maybe that means that renewable diesel production continues to be a little bit below our expectations, if not in the next couple months, then maybe in November and in December. On the other side of the coin, biodiesel production rose to a 2022 high of 152 million gallons. That's still below where what we produced last year, just slightly, which was 155 million gallons. But I think it reflects the historically high biodiesel margins that we have been seeing over the past month or 6 weeks, or maybe even a little bit longer than that. And certainly the higher biodiesel margins that we've seen relative to what we saw for quite a long time before that, which was basically sort of 5 cents one side or the other of zero. Or I guess that was before we added in the glycerin. So if glycerin is, call it 20 cents plus or minus 20 cents that we saw before. And today margins are closer to $1 or above $1. Now we expect biodiesel margins to come down a little bit too, but we expect them to stabilize. And with that, let's look at what margins did and hopefully our forecast. Boy, that's interesting. I honestly don't quite know what's going on here. I apologize for that. Now we'll check that out after the webinar. I doubt that we expect biodiesel margins to shoot up that much in the last week of September a year from now. Anyway, as you can see, like I said, we kind of expect renewable diesel margins to continue to come down. This is in part due to steady to maybe a little bit lower energy prices, and then increasing fat and grease prices. And remember, our renewable diesel margin is based on a feedstock mix that is 50% BFT, 25% DCO, and 25% UCO. And our soybean, or our biodiesel margin, is 75% soybean oil and then 25% yellow grease. And so because we expect fat and grease prices to remain close to or move back towards the highs that they set earlier this year, and we have steady to slightly lower fuel prices, we have renewable diesel margins coming down a little bit. And we've got increases built into RIN prices. RIN prices could be stronger. And so maybe margins don't come down quite that much, but again, based on what we've seen and based on where renewable diesel production has been, this kind of feels like the right way to go. And it's not a huge decrease. I think margins came in, I don't know, I think they came in like at $2.17 a gallon or something this past week, and I think that we expect them to fall down to $2 or maybe just below $2 a gallon by the end of the year. Now, conversely, we expect biodiesel margins, or I guess again, if you think of renewable diesel margins as kind of biofuel made from fats and greases, and biodiesel margins, or our estimates of biodiesel margins, as as renewable fuels made from soybean oil. That's kind of the way that it's set up. We expect those to be kind of flat, down a little bit from where they have been the last couple of weeks, which is, like I said, around $1, a little bit above $1. But we expect them to kind of average about 65 cents over the balance of the year. And again, I think that is, I think the increase that we've seen in biodiesel production is a reflection of sort of this move from, you know, the 2021 lows to the highs that we've seen in recent weeks. Whereas renewable diesel production, we've seen move kind of the opposite way. And so I think that's a little bit of what's going on. The longer term implication of that, I think, is that biodiesel capacity probably doesn't start to shrink until renewable diesel capacity, enough renewable diesel capacity comes online to produce enough biomass-based diesel to offset the ethanol gap and the undifferentiated advanced biofuel mandate, or you get a decrease in fat and grease prices. The 2023 biodiesel capacity kind of remains a little bit in limbo. I tend to think that what you will see is capacity stable, certainly through the end of this year, and then maybe through all of 2023, or I think maybe a little bit more likely is that you get biodiesel capacity relatively stable until renewable diesel capacity kind of hits the magic number, and then you start to see biodiesel capacity fade out. It's hard to estimate exactly when that might happen, but that is really the only way that I could see biodiesel capacity falling next year. The tricky part about that is as more renewable diesel capacity comes online, that weighs on renewable diesel prices and probably pressures renewable diesel margins a little bit. And so I think there will be some renewable diesel capacity like we've seen this year that is supposed to open in Q2 2023 that kind of gets shifted back to Q3 or Q4 2023. And then if that happens, then I think from a rationalization standpoint, biodiesel capacity next year looks a lot like it does this year, and you probably see biodiesel margins high relative, again, to sort of the longer term average. All right, our RIN forecast is kind of not significantly changed. We've got RIN prices going up a little bit more next year than we saw this year, and challenging the highs. That's just kind of a little bit, that's based on where we are right now and some of the strength that we've seen in RIN prices recently. I don't know that I think that RINs need to be at 200, D4 RINs need to be at 200 in March. That's partially, again, the way that we forecast this stuff is partially it's a model and partially it's what I think, and I don't think that I meant for that quite to look exactly like that. Either way, I think the takeaway here is probably, again, you probably get the spread between D4 and D6 to narrow into the end of this year. It probably widens out a bit in the beginning of next year. And that means that the D4 price, while it will also depend on feedstock prices, but will also depend on where the D6 RIN is to a much lesser extent at the beginning of the year than it does at the end of the year. But while I think that the D4 could get to 200 next year, March might be a little bit early for that. I would tend to think that you probably would see RIN prices moving a little bit lower after the first of the year. So I apologize for that. And I'll go back and will adjust that here this afternoon. Okay, and LCFS credit prices, I actually took down just a little bit. This week I took them down, I think about $5, pretty much across the whole forecast period, just because while we haven't seen a big drop in LCFS credit prices, they still do kind of continue to move slowly lower, and there doesn't seem to be any impact from the proposed rule changes, which again, I think since it seems like they won't be implemented, the earliest that they would be implemented would be 2024, kind of makes sense. And since you have increasing biomass-based diesel production, then I think that LCFS credit prices probably don't bounce back and rally a lot if renewable diesel production, and I think this is one of the contributing factors to the lower than expected renewable diesel production. If renewable diesel production kind of remains at these levels, then maybe LCFS credit prices will continue to move slowly lower if we get a big surge in renewable diesel production, or like I said, if next year as more renewable diesel production comes online with the eye to ship it to California, then you probably get in a situation where increasing renewable diesel production pressures renewable diesel margins, which delays renewable diesel capacity increases and keeps biodiesel around for most or all of the year, biodiesel capacity around for most or all of the year. Okay, with that, I will stop, and only sort of 7 minutes late today. Open it up for any questions that anybody has. And while I'm waiting, one of the things that I'm going to try and do in the next month or couple of months is I'm going to try to start to shift this a little bit so that it is not always just me rambling on for 35 minutes or 45 minutes or an hour or whatever it is, and start to have more guests on that have interesting views or expertise in specific areas that I think are important for the industry. And I say all that to say that if you have any ideas or anything that you are particularly interested in or would like to see, feel free to send me a note, and I will try to find some people that are willing to come on and talk about those areas. I'm going to try and do this, like I said, over the next month or so. I already have somebody in mind for kind of the first edition of this, and I haven't spoken with them yet, but I'm going to try and get it set up, and then if I can get it set up, then I will announce it the week before, so that you know that there will be somebody on other than me talking during that week. Okay. No questions this week. Thank you so much for your continued attendance to the webinar, and have a great week. And as always, if you need anything, please reach out, send me an email, and I will try and get back to you as quickly as I can. Have a great week, everybody. Thanks for attending. Bye-bye.